Well, hello and welcome to Inside Out, a show where we focus on individual stocks with in-depth analysis, deep dive into financials, and also tell you about the key risks and the triggers going forward. Sonal.
Hi, Nigel. And not only that, we'll also speak about more triggers, more metrics that you just mentioned, and we'll also get in the management commentary. And of course, we've been highlighting the companies that you want to know about and taking a deep dive on that. So let's start with the first stock today, Nigel. What do we have deep dive on today?
Well, IndiaMART, that's a stock on our radar. Remember, they came out with an IPO in the middle of 2019, and the stock from the IPO price, well, it went up close to around 10x. But from that peak, well, the stock has come off. It's nearly half from the peak that we saw in October 2021.
Okay, so Nigel, I think the company is more into B2B, right? But tell us more. What does the company do? What are the segments like?
Well, that's right, Sonal. You know, it's into e-commerce company that focuses mainly on various aspects. It's on B2B classified space here in India. The channel focuses on providing a platform to small and medium enterprises, large enterprises, as well as to individuals. Basically connects buyers with suppliers online, and it gives a platform to diverse set of products, suppliers. It provides multilingual search, behavioral data-driven algorithmic matching based on specifications that are provided.
Okay, so matchmaking is something that you will highlight more on, Nigel, but what makes the company stand out? What is the different trigger?
Well, the company, it boasts of diversified effects across various categories, various geographies. It has strong network and also has subscription-based revenue model with negative working capital. Diversification, let's focus on that a little bit more. They claim that they're focused across 97,000 categories, 80 million products, 7 million supplier storefronts, and 143 million registered buyers across 56 industries. The company is also present across various geographies, and as you can see, metros account for bulk of the paying subscription suppliers, while buyers, well, they're pretty evenly spread across the three categories that are up for you on the screen.
Okay, so this is about buyers and suppliers, but how does their business model really work?
Okay, let's try to get to that then. The buyer requests for a quote via call, SMS, chat, or email. Now, this is the online process in which IndiaMART solicits select suppliers and contractors to submit their price quotes and bids for a chance to fulfill certain tasks or projects. The buy leads are filtered by IndiaMART and shared with the suppliers dealing in those products or services. Their CRM software team, well, it helps streamline the leads, and ultimately, sales-ready leads are converted into deals. Pretty simple, right?
Okay, so Nigel, I think you're itching to explain this to us using an analogy, something related to personal life. Go for it.
Okay, let's, Sonal, you can just read me. After all these years, you called it right. Well, let's go for it then. IndiaMART, well, they introduces the bride to the groom with the intent of marriage. But what happens from there on and how elaborate the celebrations are, well, that's their lookout itself. But let's get back to the business then. There are various categories based on the subscription fees. The top category is the Platinum, which the company claims gets around 50 to around 100 RFQs. That's requests for quotes on a weekly basis. And the other categories, well, obviously, they'll get a relatively less RFQs as well. Well, okay, we have a fair idea about business, but let's welcome Mr. Dinesh Agarwal, the founder and CEO of IndiaMART, Intermesh, to understand the business and also take this conversation forward. Hi, Mr. Agarwal. Welcome to Inside Out. Well, let's start by asking you this. Platinum subscribers, well, they get far higher RFQs, as your presentation suggests. So what premium do they pay in comparison to the average revenue per user? And also, how much of your total revenue comes in from these Platinum subscribers?
So we report top 10% customers contribute about 44% of the revenue. And normally those top 10% customers are, all of them are Platinum customer. So their ARPU will come around 1,80,000 rupees, which is probably 4 times of the normal ARPU.
We get your point, Mr. Agarwal, but we'll come back to you. But Nigel, let me come across to you first. Give us a sense about the financial parameters for the company.
Well, 2 key parameters is what you need to track. One is the number of paid subscribers, and the second factor is the annualized revenue per subscriber. And as of the last declared quarterly numbers, well, the paid subscribers were around 156,000 odd, while the annualized revenue per paying subscriber, that stood at around 48,000. Now, between 2016 to 2021, the number of paid subscribers grew at around 16% CAGR, while the average revenue per user, that grew at around 6% CAGR. Now, on a consolidated basis, Their revenues have grown from around 400 crores and could possibly end the year at around 700 crores, just going by the quarterly run rate. Margins as well over the years, well, they've improved from the high mid-teens all the way to around the mid-40s. But in the past few quarters, well, margins have dipped from those high 40s to the lower end of the 40s. The quarterly year-on-year growth as well has slowed down. Remember, they were growing at the high teens in the first quarter of this fiscal. That slowed down to single digits in the past quarter. That's quarter 3, FY22.
So got that point, and we'll take these points forward to the management now. Mr. Agarwal, as Nigel mentioned, the pace of addition on the paid subscribers has slowed down on a high base. So in FY24, you will be able to do that 200,000 mark?
Yes, of course, because last 18 months, there has been negligible addition on the customer front. And now we are, having the channel, adding the manpower and investing behind the growth. So last quarter, you saw that we had almost the best ever quarter with about 6,000 customer addition. And we guided that it will do now quarter on quarter better than this. So I'm sure 200,000 should be in visible range in FY23-24.
So some more clarity here. Will it be in the first half of FY24 or the second half?
Let's wait for 2 more quarters.
Okay. All right. Mr. Agarwal, so you're keeping us guessing sometime in FY24. We get that. But let's focus on the second important aspect. That's the ARPUs. How does it shape up from here on? Will it increase or will it stabilize at these levels?
So historically, as you have seen, it grows at around 5% CAGR. Now, especially in the last one year, it has grown faster because there has not been much customer addition. Now that we are going to add customer addition faster, I think the ARPUs will stabilize at this particular range for now, for the next year or two, and then they will again start to grow at 5% per annum.
So, Mr. Agarwal, the ARPUs will hover around this 45,000 to around 50,000 odd mark?
Yes.
Okay, now on margins, they have been trending lower and you have already guided for mid-30s margins in quarter 4 FY22. But over a longer span of time, what should the margin band look like?
Until around 6-9 months back, when this great resignation drive does not happen, I think I have been guiding at mid-30s. But now things have changed pretty dramatically in the last 9 months or so. And we are investing behind growth also. So I think it will take another quarter or two before we can again say that we will definitely go back to pre-COVID levels, which was that 28% or so. Okay, and then probably start coming back again slowly inching up 3-4% every year.
So, Mr. Agarwal, the sense that you're giving us is that the last reported margins, well, they may not hold out and they'll trend down from there. So give us a sense in terms of the broad band of margins. What should we work with?
So broadband currently, you can say that given that this whole salaries have risen specifically by 10-20% over and above what they used to rise, I think we would look at the 30% kind of range.
Okay, Mr. Agarwal, we take your point. But Nigel, we have a fair sense of what the business is and what the management commentary is like. But why has the stock halved from its peak?
Well, 3 broad reasons, Sonal, and let's take you through each of them. First up, the street believes that it's now up against a more formidable competitor in Reliance-owned IndiaMART. Second factor is the stock, yes, it's half from the top. But even assuming that they grow by around 20% on the top line and margins hold in that vicinity of around 40% odd, it's still not cheap. And finally, they bought out Busy Infotech, which is an integrated business accounting and management software for MSMEs for around 500 crores. Keep in mind the revenues of that company in the past fiscal was around 42 crores. So the street questioned this over-aggressive inorganic growth and also the utilization of funds from the money that they raised via the QIP. Well, Mr. Agarwal, the street is a little bit nervous about this competition aspect in the B2B platform online space. If you could give us a sense about the market share between IndiaMART, Udaan, as well as IndiaMART?
They both are very different segments. So SME, B2B, when you talk about somebody like IndiaMART, we are more industrial products, raw material, machinery, and those kind of things. When you talk something like Udaan, they are more like consumer products, FMCG products, and dealer distributor. So they are like now when you talk to somebody like off business, they are more like a financing company for commodities, commodity raw materials. So I think everybody has a very different market and very different industry to cater to. Is there any overlap between any of our customer base? Very, very little. I haven't come across many customers who are switching from IndiaMART to Udaan or Udaan to IndiaMART.
Got that. So, Mr. Agarwal, according to you, it's uncalled for. What the street is getting nervous about to compare IndiaMART with Udaan or JD Mart. Did we understand that correct?
I would say so. I'm pretty confident that whatever we are doing good and we are doing well in our segment, in our addressable market, and we don't have any threat per se where we would be losing any market share or we would be having any growth plans.
Okay, Mr. Agarwal, your deferred revenue is at 790 crore rupees, which gives us some level of revenue visibility. Consensus analyst expectations is that IndiaMART will clock revenues of around 900 to 950 crore rupees. Is it achievable?
See, our numbers are pretty easy to understand because what happens is the collection is the leading number, and then collection goes into the deferred revenue, and from deferred revenue it goes into the revenue. So leading number collections have been growing for the last 3-4 quarters at upwards of 30-odd%. Same is now visible in the deferred revenue. Deferred revenue in the Q1 of FY22 grew by 14%. Q2 it grew by 20%. Q3 it grew by 25%. So we can safely assume that in a ballpark figure, the revenue would follow that pattern.
So you are saying 920 crore revenues in FY23 is doable for you then?
The growth rate of around 20%, given that the collections and deferred revenue are showing the leading indicator, if nothing goes wrong, anything specifically, that should be possible.
Well, we're hoping that, nothing goes wrong in any aspect, after what we have seen in the last couple of years. But Mr. Agarwal, let's get back to your business. You've spoken about the operational performance. Let's talk about the balance sheet. You still have around 2,000 crores of cash in your books, and you've been aggressive in terms of inorganic growth by buying various companies, the likes of Busy Infotech for around 500 crores, a whopping 500 crores. Is there more inorganic growth, or do you have plans to return some part of that cash back to your shareholders, maybe via buyback?
First thing, we raised 1,070 crore to be precise, specifically for inorganic growth, saying that we will do that inorganic growth. And we gave a timeline of about 2 years. We have been able to deliver it in about 1 year time frame. I think the entire integration and everything will take another 6 months so that it can start to be revenue accretive from next year onwards. Now, coming back to the internal accruals, we have been giving a dividend paying company. Dividends have been increasing every year on. We continue to believe that we will continue to return well to the shareholders by way of dividend or buyback, as and when it decided by board and shareholders. And in terms of inorganic growth, I think a large part of what we spent on studying the inorganic companies, most of the current cream we have already done. So I think from now on, it will be more sparsely done, here and there, if we find anything good, because we have already raked a lot of the market.
So does that mean you'll do a buyback in FY23? And since stock has actually halved from peak, what message would you like to give to your shareholders?
My message to the shareholders is that if you look at the year-on-year growth and year-on-year cash collection, we have been growing nicely. Our number of customers are increasing. Our revenue per paying customers is increasing. cash flow from operations has been increasing. And so I think there is no reason to become skittish. I think stock markets behave in their own manner. Probably they went too far, or I can't comment on that. But business is going stronger and stronger day after day, if you look at it.
All right, thank you so much for joining us, Mr. Dinesh Agarwal. And that was a deep dive into IndiaMART information, Nigel. And it's time to slip into a short break now. We'll come back with another interesting stock. Glenmark Life Sciences is in the spotlight on the other side. Stay tuned.